Welcome to This Explainer. If you've ever looked at the stock market and just felt completely overwhelmed by the thousands of companies trading out there, you are absolutely not alone. The sheer volume of data, it's staggering. But what if you could instantly cut through all that noise? Today we're going to explore a systematic way to filter thousands of stocks down to the absolute best candidates. We're looking for what we call sleeping giants, companies with massive potential that the rest of the market is currently just ignoring.
So, how exactly do we do that, right? How do you instantly filter out the bad stocks, the overpriced hypes, and the risky bets to actually find those true sleeping giants? Well, the definitive solution is a powerful tool we call the giant screen. It basically acts as an impenetrable shield against bad investments, relying strictly on hard data rather than market emotions.
Okay, let's dive right into this and map out the 4 vital signs we'll use to check a company's health today. First up, ROE, the profit machine. Second, PE, our cheapness test. Third, PTB, the asset discount. Fourth, dividend yield, or getting paid to wait. And finally, we'll combine all of these to find your sleeping giant.
All right, let's start with number 1, ROE, the profit machine. Return on equity, or ROE, is really the ultimate test of a profit machine. Why? Because it measures exactly how efficiently a company's management uses your money to generate wealth. The formula is just net income divided by shareholders' equity, multiplied by 100%. Now, don't let the math intimidate you here. It simply tells you, for every dollar of equity put into the business, how much profit is management squeezing out of it.
Let's break this down into really simple terms. Imagine you give a business $100 of equity. If they return $15 in annual profit, well, that's a 15% ROE. It's literally that straightforward. You are basically looking for companies that take your money and turn it into more money highly efficiently.
So the crucial point here is our target benchmark. You want an ROE strictly greater than 15%. If a company can sustain an excellent ROE above 20% for 5 or more years, wow, you are looking at a true profit machine. But a quick word of warning here. Always cross-check this with the company's debt-to-equity ratio. A high ROE can sometimes be artificially inflated if a company is just drowning in debt, so you want to ensure that profit is real and not just borrowed.
Let's move to our second test and see how this builds. P, the cheapness test.
The price-to-earnings, or PE ratio, tells you exactly how much you're paying for every single dollar of a company's annual earnings. Let's say stock A has a PE of 25. You're paying $25 to get just $1 of earnings. But stock B has a PE of 4. You pay only $4 for that exact same $1 of earnings. Think of it like 2 fruit stalls selling the exact same apples. Stall A charges $5. Stall B charges $1 because, hey, the owner's retiring to a beach and just wants to sell out. Which would you rather pay? Smart shoppers go to stall B, right? You want those low PE stocks.
Our deep value target benchmark here is a PE below 5. Finding a solid company with a PE under 5, that is a massive deep value opportunity. Now, a PE below 10 is still very acceptable for value investors, but generally speaking, you want to avoid anything with a PE above 20. Unless, of course, the company has a truly massive, proven growth rate that actually justifies paying such a steep premium.
Moving right along to number 3, PTB, the asset discount.
So this compares the current stock price to the company's book value. Basically, what you'd realistically get if the company completely closed its doors, sold absolutely everything it owned, and paid off all its debts today. The formula is stock price divided by book value per share. This metric is absolutely crucial for asset-heavy industries. Think about banking, real estate, manufacturing. These companies own huge physical assets, buildings, land, heavy machinery. PTB tells you what you're actually paying for those hard assets.
Imagine buying a $1,000 asset for just $500. That's exactly what finding a low PTB stock is like. By buying the company's assets at a massive discount, those underlying physical assets provide a natural floor on your losses, meaning even if the business struggles operationally, the actual physical stuff they own is still worth more than what you paid for the whole company. It's a fantastic safety net.
The magic target here for a maximum asset discount is a PTB below 0.5. You're literally buying assets at 50 cents on the dollar. That said, anything below 1.0 is still totally acceptable because you're still getting the company for less than its book value. Just keep in mind, this metric is way less relevant for, say, software or tech companies that don't have many physical assets. But for traditional businesses, it's incredible.
And that brings us to number 4, dividend yield, or get paid to wait. The concept here is simple, but honestly, it's brilliant. While you wait for an undervalued sleeping giant to recover in price, you should be getting paid for it.
The formula is the annual dividend divided by the stock price, multiplied by 100%. And this brilliantly illustrates the idea of passive income. Think of dividends like collecting monthly rental income on a property. Even if the property's market value temporarily dips, you're still collecting that rent every single month, putting cash straight into your pocket.
A strong dividend yield gives you 3 core benefits. First, passive income while you wait for those capital gains. Second, it acts as a massive green flag. It signals the company is actually profitable enough to share real cash earnings with you. And third, it creates a natural price floor. As a stock price drops, its yield percentage rises, which automatically attracts income investors who will step in and buy it. Oh, and a little bonus, look for a 10+ year history of consistent payments without cuts. That's what you really want to see.
So, our final target benchmark is a dividend yield strictly greater than 5%. When you find a yield above 5% from a healthy company with a long track record of consistent payments, you found yourself a fantastic income generator that completes our 4-part framework.
Finally, Section 5, Finding Your Sleeping Giant.
Okay, let's bring all these concepts together. This right here is the most powerful tool in today's explainer, your ultimate cheat sheet. You want an ROE greater than 15%, a PE less than 5, a PTB less than 0.5, and a dividend yield greater than 5%. Here's a pro tip for you. A company that passes all 4 of these tests is an incredibly rare prime candidate. This is your first filter, your giant screen. It perfectly highlights a business that is highly profitable, dirt cheap, backed by discounted physical assets, and pays you handsomely while you hold it.
I want to leave you with this final provocative challenge. Does the company you're thinking of right now pass the giant screen? Think of a stock you know. Maybe it's one you already own or one you've been thinking about buying. Take 5 minutes today, look up its financial numbers, and run it through these 4 magic numbers. Does it pass? Applying this strict, data-driven framework is absolutely crucial to taking emotion out of your investing so you can find those sleeping giants that build true generational wealth. Thanks for joining us for this explainer, and hey, happy screening!